How's it going, YouTube? Stocks by the numbers back in action here. Happy Wednesday to everyone, the 21st. It is the official first day of summer and the longest day of the year, so I hope everyone enjoys the day. Hopefully you have some nice sunshine and everything going on over there. Okay, let's get into it. Name of the company we're looking at here, Boyd Gaming Corporation, ticker symbol BYD, listed here on the New York Stock Exchange. Shout out to the Hunger Games who asked us to take a look at this company. And basically this is a casino gaming company, and based out of Vegas. They also have locations out in the Midwest and in the South and whatnot. And basically in the numbers here, the stock has been looking pretty good. If we back up here, we look at a 5-year chart, you can see just kind of remaining flat but stable here going into pre-pandemic, of course. Then they crashed it from 36 all the way down to 644. Look at that. And then basically immediately rallied it up to north of $70. Now, obviously, these companies were receiving pops and drops during this whole time frame. Anytime another state obviously would reopen its doors and stop lockdowns, and then when negative headlines would come out, it would drop a little bit because people were worried that we'd get locked down again and companies like this wouldn't be doing very well. But long story short, even if you back up here looking at an all chart, you can see really had a good explosion there in the early 2000s and bounced around. Then, of course, 08, 09, that's when the shit hit the fan over there. And then you can see the way it rebounded and just slowly climbed over the years. And then, obviously, we hit 2020 again. We have a big crash, big drop, and then it rebounds and gets back up to even higher highs. So, obviously, you're dealing with a stable company. Again, this is a casino company, gaming company, and people love to gamble. People love to go to the casinos. So, across the board, again, unless a massive lockdown like what happens, then chances are over time, over the years, you are going to be successful with these casino companies, whether it's Boyd or, Las Vegas Sands, even MGM, right, Wynn. But basically, this is like a 1-year chart here that I backed up a little bit, and you can see we're just basically in this upward channel, just going and going. Now, of course, at any time we can retest the bottom trend line and then break down into the low 60s and high 50s. Of course, it's possible. However, even going back, looking at these earnings, you can see a beat on the top and bottom line, a beat, there's another beat, there's a beat, there's a beat. So the company really has been rolling on all cylinders. Recently, a handful of days ago, Morgan Stanley raised the price target, right? So right now, the stock's $68.10 a share. It's only down 26 cents here, a little over 1/3% here on the day. All the indices turn red. This stock is slightly red, which really isn't cause for concern. But we have a market cap here of about $6.88 billion. The company's paying a dividend, yielding out a little less than 1%. The PE is a touch below 11 right here. So on paper, it does look a little cheap. Again, you can see 4 quarters in a row beating on the EPS side. We come down here and you can see, look, $2.6 billion in revenue back in 2018, up to 3.3. And then with the lockdown, they still made almost 2.2. And again, 3.3 before the lockdown, 2021 back in action, 3.37. So, which means, again, if this didn't happen, chances are revenue would have increased from this year to this year, and then again to this year, because now, as of last year, revenue up to $3.56 billion. So not only does the revenue consistently keep increasing, but as you can see, the profit margin does as well. A handful of years ago, the company was only taking in about 4 or 5% profit margin. They dipped negative in 2020. And obviously, you can see coming out of the lockdown, 13.75% profit margin. As of last year, 18% profit margin this company's up to. So definitely, in my opinion, you could say it looks great in the fundamentals and undervalued here, in my opinion. $6.88 billion market cap, bringing in $3.5 billion last year. So even if we go just 2 times this revenue for 2022, the company should still go at least like 5-7% higher than where it is right now, and maintain that value, really. Even if you go back and look at the last couple of quarters, you can see not only is revenue yet a slight dip there, $894 million to $877, but it's basically been increasing overall. $922 million, $963 million, and of course, look at the profit margins here. The lowest, 16.4, and the highest, as we see here, about 20.7% as of last quarter. So the company really seems to be rocking and rolling here. 1-year price target, according to the analyst here, 78.71. You look at the forecast here, every single price target is above the current value of the stock right now. So, you know, you have that little feather in your cap going, and you have one person here who's saying it's a strong sell, which is interesting. I don't know if they have reevaluated the situation recently, or if they just feel potentially that, you know, some sort of obstacle is going to present itself, and companies like this, like the gaming companies, the casino companies, may run into a little bit of a roadblock. But honestly, either way, again, with the company paying me a dividend and basically how solid and stable they've been over the last several quarters and last several years, even if it went down a little bit, if I got involved today and it pulled back before it went higher, I really wouldn't, it wouldn't be a cause for concern in my opinion. And look at the profitability moving forward. Look at these forecasts here, just consistently increasing, getting above $7 per share in 2025. And also the revenue slightly increasing here. Look at this, up to 368, 371, 376. So they're anticipating that the company is just going to just slowly keep chugging along. And you can see here, even looking at these analyst expectations here for the year, they had only one miss on the EPS side back in 2017. And again, that looks like that was the roughest patch for the company. They missed on the revenue side back in 16 and 2017. However, since then, have beaten analyst expectations for the last 5 years in a row, including during and after shutdowns and pandemics. So, you know, again, we've seen a couple of companies continuously struggling to get back to where they were pre-2020. And, you know, this company really doesn't seem to be having too many issues and too many problems doing that. So that's why, again, I'm seeing a lot of positives here as to, you know, to sway me on the buy side of Boyd Gaming as opposed to betting against it. You can see the Midwest and the South, just breaking it down by the regions, again, was up to about $2.19 billion. Then we got shut down, dropped back down to $1.5 billion, which is still more than what they did in 2018. And then, of course, now you see the rebound, 233, 241. So now not only did they regain the business that they had pre-pandemic, but, of course, it has increased as well. Las Vegas locals, you can see, almost got cut in half, basically, and the revenue has since rebounded. Random fire truck going by. But has since rebounded, was at $880 million the following year after lockdowns, $886 million, and now we see as of last year, $930 million just from the Las Vegas segment over there. And then we have downtown Las Vegas, the only section really that has not completely rebounded. However, going from $250 million down to sub 100 million, now back up to 215 million. I mean, it could be worse, right? And of course, we know Vegas is probably where the most competition is, right? So if they lost, 20, 30, 40 million here, obviously they made it back here in this segment, but more importantly, in the Midwest and the South, obviously they appear to be growing a little bit, more accelerated growth taking place down in the Midwest and in the South. So that's why even if the Vegas revenue kind of bounces around a little bit, it looks like, they're one of the brand names down there in the Midwest and the South that people are going to not only consistently, but perhaps more frequently now. But we looked at the earnings. Now we come over here, random fire trucks going by. Sounds like there's some sort of emergency happening outside, but the emergency is BYD and whether we should buy it or not. And going back here, looking at the dividends, you can see in 17, the company started paying out a dividend, 15 cents a share, goes up to 23, goes up to 27, lockdown happens, they cut off the dividend. Now we're back in 2022, the company's rocking and rolling, dividend up to 60 cents per share. So the company has essentially more than doubled the dividend that it was paying out pre-pandemic. Now it's post-pandemic, right? So you have a company coming out of this lockdown with flying colors, consistently increasing business, consistently increasing profitability, and now increasing the dividend out to shareholders as well. So that's why, really, any way you look at it, you definitely have the positives outweighing the negatives here. The PE has been a little bit lower than where it is now, but it's still sub 11, as we see here. Pre-pandemic was maintaining 20 plus. So again, I'm not saying the company is going to double in value. However, if this PE just consistently keeps increasing, and all of a sudden we're trading, 13, 14 and a half times earnings, 16 times earnings again, it really wouldn't be a ridiculous valuation. It would actually be pretty realistic. Price to sales, again, was up at about 2.25, has now since pulled back to about 1.94. I mean, technically you can say it's undervalued, not really the metric I would use, but even going back, you can see the price to cash flow ratio as well has been higher, has been lower at some points. But again, coming out of the pandemic, the stock was, the ratios actually seem to be a little bit higher. So that's why, believe it or not, sometimes they keep them flat or they don't have the stocks move that much to justify the next 1 or 2 quarter breakout down the road, right? So keep that in mind. Right now, price to book 4.18, so it is a little bit higher than where it has been in the past. However, you can see was up to almost 5 times book value. So we've seen more out of hand, unrealistic valuations in a lot of other stocks. So to tell me a company this solid, this stable, that's paying a dividend to shareholders is trading 4 times book value, not the craziest thing I ever heard. The enterprise value, which kind of I feel like is hit and miss depending on the situation, but this is interesting because apparently enterprise value, again, is basically what another company would pay to buy out this company at the current valuation. And right now you can see enterprise value $10.4 billion and market cap $6.8 billion. So if it gets up here to this level, I mean, that would be a 66% move, roughly. And obviously that would result in a very nice profit. But, realistically, probably not going to happen. But again, to say on paper that other companies would say it's worth more than it is now, I mean, yeah, I guess that's a little feather in your cap too. Return on assets has been increasing for the last couple of years, along with the equity, along with the return on invested capital. Really, the only thing that's down you can see here is the gross margin. And again, was up at 49.5, slightly pulled back sub 49, now slightly sub 48. Is it going down over the last couple of years? Yes. Looking back, though, it is still the best it has been since post-pandemic, really. So the company has really gotten its ducks in a row and really started rocking and rolling just in the last 2 to 3 years since said lockdowns. Operating margin has been consistently increasing, as we see here, coming out of 2020. Jumps up to about 27.75, north of 28.5, now above 30% on the operating margin. EBITDA, once again, earnings before interest, taxes, depreciation, amortization. You can see kind of bouncing around, but also minus this one dip, was slowly increasing. You can see the low 23s up to north of 23.5. Then it breaks through 24, and then of course we have our post-pandemic explosion, EBITDA margin now north of 37%, 37.6%, now sitting at almost 38.5%. And the net margin percentage obviously following suit. You can see was mid to higher single digits, drops down negative there in 2020. Was that 20? Yeah, 2020. Drops down to about minus 6%, and then, of course, since then has skyrocketed up to 13.75%, a touch below 18, now 20.7% on the profit margin. So, again, a lot of good things going on here. Look at the inventory turnover, right? So the inventory turnover, was in the 80s, got up to almost the mid-90s, obviously took a huge hit, drops down to sub 60, and then since then has completely rebounded, basically higher than it was, approaching the highest year so far, and has since rebounded to about 80, north of 86.25, now at 88.68 on the inventory turnover. And of course the asset turnover as well has been following suit. Again, the asset turnover can be measured, can be used to measure the effectiveness of which a company uses its assets to generate income. The higher it is, the more efficient the company is, since higher ratios mean that the company generates more income per dollar of assets. So obviously, the higher the better. And as we see here, was slowly climbing, got up to about half, 0.54, took a big hit in 2020 down to 0.33, and then resumed and got back to and higher than where it was pre-pandemic, going to 0.53, 0.56, now up to 0.58. So, I got a lot of trucks and stuff going by out here, but just stick with me here. Long story short, on paper, the company, in my opinion, looks absolutely phenomenal, believe it or not. The cash is really rocking and rolling. Well, as you see here, cash from investing activities currently is taking a pretty big hit here. However, the cash from financing obviously is heading in the right direction, but the company still has positive cash flow and obviously is profitable. So those things really wouldn't raise too many red flags for me, in my opinion. Assets took a dip back in 2021 down to about $622 billion, now back up to $6.54 billion. not the highest it's been. However, check this out. When it was higher than where it currently is, look at the liabilities. Around 5.4, almost 5.5 billion. Now, with the similar amount of assets on the balance sheet, the company now has total liabilities sub 5 billion, which of course assets minus liabilities yields equity. So now the company, as we see here, 1.59 billion in equity is the highest it's been going all the way back to 2016. Company has several $billions in debt on the balance sheet, but as we know, debt is money, so that is not really the biggest red flag. As long as assets outweigh liabilities, in my opinion, I think you're on the right track. Book value, again, as we say, right now it's trading a little, just about 4 times book value, and could be viewed as low, could be viewed as a high ratio. However, more importantly, you can see consistent increases in book value going into 2020, pulls back just slightly below where it was really in 2018, and since then, again, absolutely exploding. Book value in 21, $13.82 a share, and as of last year, book value sitting at almost $15.50 per share. So, again, all of these metrics really seem to be, for the most part, consistently increasing. So, again, I'm seeing a lot more positives than I'm seeing here with negatives. We looked at the revenue consistently increasing and getting above where it was pre-pandemic. The cost of goods is lower than where it was in 2019 at the highs before these last couple of years after the pandemic. Of course, revenue minus cost of goods sold is gross profit. You can see up to 1.73 billion, basically the highest it's been going back to 2016. Operating expenses, notice how revenue went up, operating expenses has gone down from 21 to 22, which of course increases the operating income, which is gross profit minus operating expenses yields operating income. So now the operating income is a touch below $1 billion. That is the highest it's been going all the way back to 2016. So again, the company really, in my opinion, seems to be doing the right thing. Not only are they, increasing the foot traffic coming to their locations, but of course they are generating more revenue and, more importantly, earning more profit off of each dollar that they take in. And you can see, again, look at this, pre-pandemic, again, the PE was well above 20 and has since dropped down, as of last year, 9.3. Right now, again, sitting at 10.7. So, really, in my opinion, this is what you look for, really. This is what you look for. The only thing is, again, kind of an interesting scenario here. Again, I want to show the debt, as you see here, consistently increasing pre-pandemic, getting up to $484 billion, and then has since pulled back almost $1 billion in the last couple of years. But also, what is that? The free cash flow, as we see here, gets up to about $700-800 million. Before that, was maintaining, $200-300 million. So the company, again, more positives than negatives. And of course, I understand short-term liabilities are outweighing short-term assets, but of course, total assets over liabilities are it's a positive ratio. And again, you can see the history beating 4 years in a row on the revenue side, beating the last 4 years in a row on the EPS side, and again, stopping the dividend to keep everything in order at the company, and then going from 27 cents up to now 60 cents per share. I mean, you just can't deny the positivity, right? You can't deny the positivity. And as we say, watching the revenue grow and watching the company become more and more profitable over these quarters and over these years, like I always say, follow the money. If this company is trading at cheap multiples and revenue consistently keeps increasing, then again, I understand you may not find the ideal perfect price to get in and get out. However, at the end of the day, you're buying a pretty damn decent company doing some pretty good business here. Switching over to stock charts very quickly, you can see here that it has dipped a couple of times below this 50-day moving average, but for the most part here, really going back from when the ball dropped, it bounced off the bottom Bollinger Band, got up above the 50-day moving average about mid-January, and again, minus a couple of small dips here, has basically stayed above this 50-day moving average for about the last 6+ months straight. So to buy it, in my opinion, right at or potentially a little bit below this 50-day moving average, and I think you'll have a pretty good entry. The RSI sitting here at about 53.25, and it does look like the MACD is potentially curling. However, in my opinion, You have to wait and see. Again, it may retest this 50-day moving average right around right now about 67.30, just like it did here. However, again, it has recently broken below and just gotten above that. So in my opinion, if it retests, it should really bounce and go back higher. But again, keep an eye on it if you have this on the watch list. And the main level you want to watch there is that 50-day moving average. That will determine in the immediate short term whether it's going to bounce and go higher or obviously break and go lower. And you can see here the stock, since we're looking at tail end of September, has basically been in a massive uptrend, right? And that took the bottom Bollinger Band from down here about 46.5. Now it's sitting at 59.68, the bottom Bollinger Band, which is right around the 50-day moving average on the weekly. So now that could potentially be your bottom, really. So that may be your biggest loss. And of course, since then, since rallying going into October, the stock really only at one or two little occasions, again, has dipped below the mid-Bollinger Band as well. So now if this is potentially, hypothetically, your max loss at about 59.5, and then, of course, in the short term, your pullback could be the mid-Bollinger Band, which is only 65.5. Obviously, it does seem like, in my opinion, we have a lot more upside than we have potential downside here with BYD. And the RSI here on the weekly, about 59.33. So still has room to go higher. Could, of course, break lower. But right now, I'd say, if they want to keep it down and suppress it like they have been doing with materials and industrials and telecoms and whatnot, I guess you can say technically, maybe it's fair valued and it might not, run to the moon. But also at the same time, it really shouldn't drop too much either, right? So if you're looking for something pretty stable that has the potential to grow for you, that of course is paying you a dividend to own it and looks like they may potentially consistently keep increasing it moving forward, then Boyd Gaming, ticker symbol BYD, may be one that you may want to consider stepping into or at least throwing on the watch list for now. But I think that was a pretty decent video, right? So we'll end it there. Once again, Stocks by the Numbers. Thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Like the video, thumbs up, algorithm, share the video. Helps me get more eyes on the channel. Do me a favor, handshake agreement. I have no problem you guys dropping all of these symbols in the comments section. I'll make a video on them as soon as I can. Hopefully it helps you out. If you have any questions, you can join the Discord. Again, I'm usually very quick to answer. I'm always open to help everyone out. All I ask, again, handshake agreement. I'll do whatever you guys ask me to do. Just do me a big favor. Push the subscribe button. That is how you help me help you. I just want to see the community just consistently keep growing. And for the most part, the calls have been accurate. And pretty much everyone in the Discord and everyone watching these videos should be up more than you're down. Of course, that is solely if you've been following my recommendations. I know we all like to make calls ourselves. And also, I know that there were a lot of other, YouTube stock hobbyist channels out there who are making their calls as well. So I know sometimes it seems like a lot of noise. It seems like a lot of recommendations. You don't know who to trust. You don't know what to do. But again, my track record is speaking for itself. And no one could be 100% correct. And if you really want to find the person who is always correct for the most part, well, then you should be following Nancy Pelosi. What are you doing watching me on YouTube, right? But nah, that's enough. So, once again, Stocks by the Numbers. Thanks for stopping by. Moving forward, like I always say, I understand that markets are rocky and volatile and uncertain. So I do want to wish everyone success. I hope everyone makes a couple of dollars. Thanks for stopping by. I'm going to catch you guys in the next video.